But we've got a very special interaction planned for you on this occasion with a very special voice joining in on the show. I'm talking about Yatin Shah. Yatin Shah is Executive Director at IIFL Wealth, one of the largest wealth management companies in India. In fact, not only that, he himself is a young achiever and was the co-founder of IIFL Wealth almost a decade back. He has a pulse on what the super rich right now are doing, how are they investing, the kind of conversations Yatin and his colleagues are having with them across the country. So Yatin, first of all, thank you very much for joining us on the show. It's your first interaction on ET Now. I welcome you on our channel, looking forward to more chats with you. But right now I want to understand what's going on in the mind of the super rich in the country. Your conversations with them in the last few months. The Haroon Rich List is recently out too, which you guys have together. What are your insights on this affluent community, the way they're looking at the investing landscape?
No, I think so. For when it comes to HNI investing, it's I would repeat this quote from Morgan Housel. Personal finance is as personal as it gets. In long run, it's always about the managing volatility. The kind of investors we deal with has already created the wealth. So it's when the wealth creation has already taken place, they come to financial markets investing in financial instruments with the primary focus of wealth protection and wealth preservation. So it's not about the highest return. I think so. It's always about the right return for the right family. So in long term, it's more about consistency, about your return on your total financial assets, and in near term, it's navigating the minefield, the maze of avoiding bad decisions or factors like greed and single stocks, single instruments, single asset classes. So you have to have a very balanced portfolio. Diversification is the key in investing, and most of our clients focus on to ensure that in longer run they don't end up making any big mistake, and they are able to achieve their target return and objectives through right set of asset allocation and risk return adjusted returns.
Fair point. In fact, bulk of them have already achieved much of their wealth, and then it's more about staying rich than getting rich, because getting rich part is already achieved. And working closely with advisors like you, the priority is capital preservation, staying rich, compounding your wealth in low volatility manner over the years and even over generations. Let's talk about the two parts of their portfolio. They have 40 to 50% of HNI portfolio up till now has been in fixed income. Fixed income has gone its own shares of issues now, with rates coming down, some accidents in the mutual fund side, and in general the yield on fixed income is coming down. Equity, on the other hand, how are they looking at equities? So on both these key asset classes, what are you advising? What are your thoughts and conversations with them?
So, if you see last, it's a very interesting trend emerging, actually speaking. You see Nifty index, it's hit multi-month high today. In fact, the returns are very polarized. In fact, only 15 stocks in the Nifty are up almost 30% year to date. Almost 35% are still negative by almost 24-25%. So year to date, Nifty is down to 3% and so on and so forth. Pre-COVID, the forward Nifty valuations were almost 22-23 times. Post-COVID, there's been a downgrade for FY21 earnings. The markets are richly valued. Of course, long-term investors are discounting FY21. Other interesting data points for equity investing is the price to book in near-term, long-term average is fairly valued. Market cap to GDP is closer to 80%. It's almost 15-year average. The real relative attractiveness for investing in equities is coming from the lower interest rate regime. So that's causing markets to remain richly valued. I think so. The investment options available with investors are quite few, and that's driving the valuations up, including cost of capital and so on and so forth coming down. You will kind of give companies which have no debt, have great cash flow in monopolistic situation, high ROE, dividend paying companies. will always attract richly priced. So this Nifty is showing the polarization. And increasingly, if you see what's happened last 10 years in developed markets like US, Dow Jones and NASDAQ, I think so the interesting fact which is coming up is the composition of index is changing, increasing weightage of financials, industrial and manufacturing companies is now getting changed with IT, telecom, pharmaceuticals, and so on and so forth, consumer goods, and I think so. Increasingly, you will see now, India also will see a change. So last 5 years, almost 25% of the Nifty companies have changed, and next 5 years, this change is going to get accelerated by representation of companies from consumer tech space and so on and so forth. Coming to your fixed income point, I think so. Fixed income has been a very tough last 3-4 years, particularly in India. It's, most times it was about what not to do in fixed income, how to manage the credit risk part. I think that's been a very tough journey for most investors. I think so. Fixed income is not about a return on capital, it's return of capital. So we've kind of sticking to credit, with AAA, ensuring that they give FD plus returns. The timelines are not excessively long. 1 to 3 years, investors should expect 4 to 5.5% post-tax return and stick to quality names. I think so. The first time we've seen a dilemma for investors when a savings bank rates is more than the liquid fund. So those are the challenges which investors has to face today, and kind of not overcommit and be reasonably invested in equity, and same time constantly be ensuring that the fixed income portfolio has zero credit risk. So that brings us to the alternative. What are the things which is outside equity and fixed income where clients are investing today? And I can answer that question to you once we can go into the conversation further.
Let me come to that. But when we are discussing asset allocation, one of the preference of the super rich across the country traditionally has been real estate, especially rental realty, good yield realty, be it office spaces, etc., shops in physical or some structured products around it. But real estate does form a reasonable part of their portfolio. But now it appears that the premises of real estate has got shaken quite meaningfully. It's just the affordable income realty which is doing well. In such a scenario, how are they analyzing this part of the asset allocation? What are you telling them? Are there some emerging trends which they are open to looking into?
I think the trend has been very, very interesting. So we had done a recent survey, a couple of years back, and increasingly speaking, you've seen this change and trend shift also happening. Last 10 years has seen a massive shift from physical real estate to financial real estate, or also physical assets to financial assets. And that trend has got increasingly caught in terms of where regulations in India is shaped up. If you see in last 2-3 years, I would see a big emerging trend. Actually, real estate is a sector which nobody likes to talk about. And it's, of course, the last 10-15 years, it's been the dampener in terms of overall return in anybody's portfolio. But if you look at, see what's going to happen in next 5 to 10-15 years, it's everything which is right for the industry is going today correctly, which you would have expected. You have a SEBI-like regulator like RERA in place. You have, you had a demon which weeded out weaker developers. You have a low interest rate regime, which is what makes houses very affordable. Post-pandemic, you have a situation where a lot of soaps and incentives have been given to buy property for lower stamp duty. And the biggest is, I think, so the REITs regulation. What REITs regulation is doing in India is creating a financialization of savings into real estate assets through financial instruments. And that's a big trend. If you go back globally, it's a very important asset class tool for allocation for HNI investing. And now this tool is also available for retail investors. So you've seen last two big successes in last 15 months post regulations came in is the Embassy REITs and Mindspace REITs. And there are now almost 50,000 crores of financial instruments traded in form of real estate REITs, which is nothing but a commercial property giving you rent to retail investor. And that's a very attractive post-tax return, I would say much better than a fixed income, but of course it comes with the variability in the shorter run. So these trends will attract institutional money. They'll bring down the cost of capital down. like every other industry, the leaders in this industry will get the maximum amount of capital, which will kind of encourage retail and HNI investors to kind of invest in their instruments through either REITs or through the equity paper. And that sector will, I think so, will emerge quite strong, which was all the wrong reasons for last 10, 15 years have been lying low.
Right. Let's talk about flows. We are witnessing, some trends that the tier 2, tier 3 cities adoption of financialization is good, and the surge of new investors and traders is also happening. Surely the data from the mutual fund side got shaken a bit earlier, and the fresh data is also flashing on the screen right now. But when you interact with your advisors and the network across the country, do you see there is change of heart towards equity as an asset class? And from the tier 2, tier 3 cities, the allocation could go up next couple of years. Also, some entrepreneurs who become wealthy in tier 2, tier 3 because of democratization of overall wealth, because of technology. Is that likely to show up big time as well going forward?
So you've absolutely right in your assessment. The one big trend is financialization of savings. I think so. If you pick up tier 2, tier 3 cities and you see last 3 years of mutual funds growth, it's almost 100% growth in cities like Indore, Lucknow, Baroda, and so on and so forth, which talks about the level of financial literacy and awareness of investing in financial instruments. The other big data we see is the total share of HNI wealth. The total share of HNI wealth for previous 10 years was dominated by physical assets. Now today it's got dominated by financial assets. More than 50% of anybody's wealth is coming into form of financial assets and no more just physical assets. The third I think the trend which we are seeing is increasingly, it's no more about investing in single instrument, single stock, or a single asset class. I think so there's an increasing awareness of creating what you call is a asset allocation portfolio which suits one individual's need. And the entire focus has now gone not to make the highest return, but the right return, which is managing the volatility, and the capital preservation has become the key. So if you've seen these trends, what's happened is, I think so, last few years, I think so the increasing life cycle of somebody's business family or an entrepreneur to create wealth used to be 30, 40 years, and most point in time used to leave that business wealth for succession planning, and his second generation should take over. I think that all has changing on is changing, and it's almost very stark. I think so increasingly the life cycle of the company and wealth creation is now shorter, 10 to 15 years. Nowhere that the client is looking to transfer this business to second, third generation. There are increasingly first generation entrepreneurs are very happy to see an event of liquidity, strategic, or hit the IPO market. And bulk of that wealth creation which is happening in their core business is coming to investing in financial markets through service providers like us. And then the focus becomes wealth preservation. And wealth preservation means that you have to have a asset allocation approach. You have to break your investing into different buckets, starting from fixed income, equities, alternates, international investing, and gold, and so on and so forth. So I'm very, I would say very excited that it's in next few years, especially you would have seen IIFL Wealth Hurun list with almost 200 new wealth creators, despite of unprecedented pandemic and situation what we were last year. Happy to see this kind of numbers. And precisely the point you made is how institutional capital, how technology has democratized the wealth creation in India. And generally, there is the new wealth doesn't have the face. It's coming from all across. They're getting equal opportunity. Unlike before that the entrepreneur had to wait in a queue or apply for the bank loan to start a company. Today, if you're an honest entrepreneur, you have a good business idea, you have a good education background, likes like IIT, IIMs, or studied abroad, you have ample amount of institutional capital to give you kickstart in your new venture. And the life cycle of that company is changing. So if you see new age companies, especially in tech space, entrepreneurs don't own 60, 70, 80% of the company. They own 15, 20, 25% of the company. And bulk of the company is owned by private equity investors, institutional investors, strategic investors. So these are all healthy trends which will accelerate the pace of wealth creation. Eventually, wealth creation at some point in time will lead to amount of liquidity, which eventually will come to
Right.
service providers like us who will focus on wealth preservation and wealth protection.
Right. All right, Yatin, we'll let you go on that one. I think part of that answer is also coming from personal experience, but I wish you all the luck going forward for steering the business ahead. Thank you very much for your time. That was Yatin Shah of IIFL Wealth joining us on the show. But the numbers on your screen right now indicate the flows from the mutual fund community. My colleague Jayesh is here to slice and dice the data of which has been coming in. Jayesh, what are you reading? The pressure continues, isn't it?